Hello, it's Randy Patrick here, Housing Bubble 2.0. Hope everyone's doing well. This is a little different format from what you typically see from me, because normally we talk about news of the week and stuff that's going on in the real estate industry, and I commentary about the current events, values, what's going on, etc., etc. But I'm creating some playlists now, and the whole idea of this is to sort of give some backdrop into what's going on in the industry, more thought process, more discussion on specific topics, etc., etc. So what I wanted to do to set the stage for this is actually go back in time and revisit the last housing bubble. So of course, around 10 years ago, we experienced what really was, up until that point in time, a real estate boom. And of course, we had a bust, a crash, and a crisis. And now we've been sort of through a recovery. So I'm going to talk about some of the things that really drove the housing bubble, or contributed to the cause of the housing bubble. We'll discuss those sort of points, and then you can make your own determinations and figure out whether you see similarities right now comparing what happened 10 plus years ago. So a decade, 10 years sounds like a lot of time, and a lot of things happened. We've come a long way since then, and we have a lot more knowledge. So of course, my perspective is, we've seen this, this again, the boom, the bust, the crash, the crisis. And can we learn from it? Can we use that information to predict the future? Can we maximize that information to position ourselves, accordingly for whatever you want to do, whether you want to buy your primary residence, you want to invest, you want to build wealth or earn income, all these things that you may want to do within the real estate environment. We have almost like a complete cycle to look at and to learn from, and take away that information and apply it to what's happening right now. So that's kind of the thing. So we're going to look at specific items, that drove the last housing crisis, that contributed to it. So I'm calling this segment, this playlist, Game of Homes. So clearly, Game of Homes is a little bit of a take on the Game of Thrones series that just ended a little while ago. And the reason why I call it Game of Homes is because that's what it really is. If you take a look at the industry, mainstream media, what certain groups and industry and parts of the industry are telling us as to what's going on really happening in the industry, I think there's a divergence there. I think there's some differences. There's different opinions. I don't always believe what I hear in the media, and that's what my point to you. So, what are we playing here? We're playing against time. We're playing against, other companies, mortgage companies, groups that want us to go buy property at the peak of the marketplace, with the government, Wall Street. So, that's who we're playing against. So that's really, for me, it's a game of homes. That's kind of my theme for these playlists here. So how we're going to do this is we're going to work our way. So I've got a top 10 signs of a housing bubble. And again, that's based on what happened in the last housing bubble. It's historic, but I think it'll be great information. And then we're going to work our way from number 10 going, in ascending order from 10 to 1, and we'll do a couple per video. That's the scoop on this. So realize that stuff I'm going to talk about, some of the things we talk about here will contribute to other points and drivers of the last housing crisis as well. So just keep an open mind, and we'll go from here. So again, my first point with respect to number 10 here, that the reasons why we had a housing bubble, burst, crash, crisis, whatever you want to call it. Developer investor profit. Now, developer investor profit disappears. And that's, of course, a sign that we have a bubble happening. Now, we saw back in the day, what did we see? Well, we saw increased construction, increased development, and we saw more homes being built, both from a subdivision perspective from builders, and also in maybe specific cities or locations within cities. We saw a lot of on-your-lot builders, custom home builders, come into the foray into the marketplace as well too. Well, with subdivisions, we saw rapid expansion. We saw selling out phase 1 and move to phase 2 or phase 3. And some of the issues that maybe you saw was that phase 2 became cheaper than phase 1. So when you bought phase 1, the builder and developer already undercut your price points, and what you got less from the next buyers, which is not great. Builders were dropping price, and they gave incentives to real estate agents, and they gave incentives to buyers to clear out the inventory and move it. Spec homes, they built it with the thought process, you build it, they will come. Well, spec homes, sat longer and longer on the marketplace. Excuse me. And, again, builders were taking a bit of a heat, and they were doing what they could to unload inventory. So the on your lot guys, and I had a lot of experience with this back in the day as well too, on your lot typically was taking land, building a home, or going into specific areas of town and actually buying the lot with the old house, doing a tear down, and building a new structure. And that's sort of, gentrification was the sort of term for that. You go into neighborhoods that were older and you'd essentially tear down and put new structures up, and you were slowly starting to improve the neighborhood and improve property values and whatever. So that kind of brought in the advent of the construction to perm loans. And, at that point in time, back, in the last housing boom, they were great loan terms. The loan to values were high. Loan to values on a lot of, at least in our area, loan to values were based on the appraised value of the home after the build project was completed. So therefore, you had the ability to maybe not even put any money down on it. Some of these loan programs rolled in the interest rate. You're paying your interest every month on your construction perm loan. Some of these guys actually made an interest reserve account and actually rolled your interest loan into the overall loan, so you could jump in and not pay a dime and have everything paid for based on your loan to value at appraised value. And the thought was you'd make money with no cost out of your pocket. So totally no risk, no fuss, no mess. So that's interesting. So this stuff did go on, by the way, and it went on quite a bit. So developers and builders got caught with that. We had issues along the way. We had issues with materials, raw materials, labor force, the whole bit. So, excuse me, everybody wanted to do this. And of course, when that happens, it taxes the marketplace, it taxes the builders, it taxes, the environment, and things can change, and the environment change, things can take longer, and that's what happened. So things were taking longer to do, longer to complete, and the housing market was changing, which caused chaos. We also had a lot of things that went on with respect to condo conversions. And what that really was taking a rental apartment complex. So taking like just it was apartments that you would have for rent. A developer would purchase that, and then they would convert it into condo units. So the whole idea was you take a rental property, you'd phase out, so you wouldn't renew leases or you'd evict, whatever made sense. Then what you would do is you would improve the property. Typically what we'd see is, interior, you'd see granite countertops and some new paint and maybe some new flooring, and you'd see stainless steel appliances. That typically was the norm. So a lot of these were becoming almost cookie cutter, same sort of, everyone would have a similar look, etc. But you were now, because it was the housing boom and you wanted to get in the game, you bought, an apartment for, $250,000, $300,000. You got the mortgage for it, and that was great. So the developer was actually going through that, and they'd phase through, et cetera, et cetera. Well, what would happen is that at some point in time, as the housing sort of, bust happened, you'd have a developer, being stuck with these properties that weren't sold, that people wouldn't buy them. You'd have people who purchased them, for $250,000 or $300,000, and guess what? It doesn't make sense anymore. And now you've bought a condo where you're living in a development where the developer now has to rent out those units and devalues your property. So we had a lot of people in that situation that either couldn't pay for it anymore or decided not to pay for it, and they couldn't sell, so they did a lot of short sales and had a lot of foreclosures. So that's where issues happened back in the day, and of course it's that's developer profit, investor profit disappears. So everything booms up, and you're planning, okay, we're here right now, and we plan our projects, which may take a year or 2 years, but if in that point in time, if we've peaked and we've crested and we're coming down, then the numbers that they're working on the comps over here don't make sense anymore, and it causes chaos. So there you go. Excuse me. Going back to the whole knockdown and development, it was highest and best use opportunity, obviously. You maximize the square foot on the parcel. So if I knock down a 1,000 square foot old house on a certain lot, the new zoning allows for a 3,500 square foot house. So the whole idea was you're knocking down a 1,000 square foot house, but you're maximizing square footage on that parcel, which then you can sell. So of course, at your per square foot sales price, that's where you're making your money. So, and it's not just where I live in Florida. Other locations, it was build up or build, or rezone it for more density. So those things were happening. Other locations, for example, like New York, I don't know how many projects I saw going on that, they're taking some parcels and building, these 4, 5, 6-story developments, etc., selling them for $1 million plus. So that stuff was going on. And again, it's maximizing what's available. And if you can rezone and do all that, that was great. So you saw a lot of that happening, not just down here in the Florida area, but other locations across the country. Now, what we also see as signs of housing bubble issues is luxury properties. So of course, not necessarily like the little McMansions when you're maximizing square footage, but people are now building huge homes. They're building, 10,000 square foot homes. They're building multi-million dollar compounds in the Miamis, the West Coast, the New Yorks, the Palm Beach, etc. over here in Florida. So we have the mega developers coming in and doing ultra rich, ultra modern, whatever it is. And those, or also say, for example, Miami area, you've got high-end condo developments. So we're talking, high rises with, $2, $3, $4 million condos, penthouses, whatever it is. So exclusive residences. Yes, they're building in services and amenities, but the whole idea is they're charging a lot of money for that. Well, the problem is that people get caught. So by the time you develop and build out and sell and get people in there, the market was changing. Developers were getting stuck, and a lot of people who were buying those. So don't forget, you got a developer who's building, and they need to make their money, but also to get people in the door to purchase and get that sort of critical mass. Who buys? Speculators and investors. So you got people who, I'll buy it for $1 million, and by the time it's done, I'm going to sell it for $1.5 million or $2 million, whatever the numbers are. So those people are actually not even owner occupants. They're rolling the dice on the growth factor and the speculation and the ability to make money, when it's completed, and that wasn't happening. So then you'd have, they would default on their loan, or they rent them out, and or eventually get foreclosed on. And developers, same thing. Developers would have issues with their own financing, and eventually, as they completed units, what should have been for sale is now for rent. And it's just, like same thing. You've now bought a unit you're trying to sell, but it's rental. Half the occupants now are renters. So it doesn't really make sense. So therefore you have double whammy. Developers losing money, the speculative investors losing money as well too. So, and at that point in time, money seems, it's easy to get money. So you have foreign investment. Certain locations across the country are hubs for relocation, for immigration, for money coming from other locations like the New Yorks, the Miamis, the West Coast. So we have foreign money coming into the U.S. here. Really, it's cash, and they're buying. Now, we've talked about this before, just with respect to what happens, say, in the West Coast. This is sometimes investment money, but sometimes it's referred to as flight capital. Many times people want to get cash out of their country for various reasons, and the easiest way is to park it in a property and pay cash for it. And the people who are doing that are not necessarily looking to flip and make money. It may be more of a function of, I just want to get my money out and park it. So it's a place, it's a domicile. I can, and there are immigration policies where if you're buying real estate or you're buying, a business or certain things, and you're investing in the U.S., that's part of the process to become a landed immigrant, a resident alien, eventually a citizen. So people were sort of going down that path. So again, foreign money coming offshore, really helped to prop up some of these marketplaces, especially in the bigger cities. And that's where we see, the mega stuff goes big time. So again, it grows and grows and grows, and then people say we can't afford it. And then you now see developers who are, a $20 million compound is now $10 million, or whatever the numbers are. They're just trying to get out. So we saw a lot of that going on. We had a lot of horror stories with respect to people who were buying, paying record numbers for properties, and then getting financing as well, and then being foreclosed on. So a lot of that was happening back in the day, which is, again, so all this, what does it lead to? Historic prices and historic margins. People were making money, no doubt about it. They thought it was easy money, and they'll make 25-30% return minimum in a year, and they're also making huge flipping profits as well too. Excuse me. So the concept at the time, though, was never thought of losing money. So I'm going to buy it, and it's going to keep going up. So I'm in a great position here. So people saw this, and they had to get into the game. So therefore, when you have the true developers, doing this, and it's enticing people, then the next level of investors and speculators jump into the game, and they have what I call them excessive investment. So they're buying more than one house or one unit. They're flipping just with the expectation of making money and doing no improvement on property whatsoever. It's just because you have a contract, or you bought it at X number of dollars this year, and you expect in 6 months or a year to sell it for 50% more where the numbers are, just because of the marketplace. A lot of people who did this never actually ended up putting extra money into the property, or never intended on it. And it's one of those things where this is what we dealt with, people who that was the whole thought: buy it, and in a year it's going to be worth this, and we'll just sell it and we'll make money. So what eventually happens to that segment? Well, again, that's part of the whole bubble theory. So we keep seeing it going up and up and up. People get excited and they get involved, and they can't foresee, a peak value. They can't foresee a plateau or God forbid, a decrease in value. That's just, it's not in our bailiwick. It's not in our, we're not thinking about that, and that's what happens. So in the end, profits decrease. So you're not making as much money, on your flips or on, from year to year holding property. That typically starts to happen quickly. It's not like it takes 4 or 5 years to ease off. Typically, we see much, faster, negative exponential decreases, and compounding all this for developers and home builders and investors on your lot guys was a situation where we had so much going on that there was a shortage of materials. A lot of the labor force was being stretched on so many projects because we had so much development going on. That it was tough, and I remember, because I got caught in this as well too, is that we're building stuff, and what should have been maybe 8-9 month process was taking an 18-month process. And what does that do to you? That increases your cost, your holding costs. It increases your interest payments. It diminishes your opportunity cost. And in the end, either you're renting it out or you're losing the property to foreclosure or giving it back, whatever you're doing. So, all these things compounded into investors losing money. Permits, a lot of local county and city governments were inundated with respect to requests for rezoning, for building permits, for permits for just your basic stuff, for air conditionings, for roofs, for plumbing, electrical, whatever. So when you have a surge of that, it taxes local infrastructure, which slows down projects. And also there were certain parts, at least I can tell you certain parts of our state here in Florida, where the government started to catch on. And what I mean by that is they realized that there was so much a starting, like the starting of projects going on, but there wasn't enough completions. So they started getting wise to this, and now they were starting to demand that builders finish projects before they keep applying for new ones and new permits, because you could have 100 open permits on custom or like subdivisions being built, but yet nothing was being closed out, which to me there's no finality there. So we're not closing a project. So there was a lot of people that got hurt on that, and people who relied upon the flipping and getting that done to earn their income had longer delays, started having to pay interest or on the carrying costs, etc. That was not in the plans. That was not what was sold to them. That was not the concept they bought into, and there were some serious issues that occurred that really helped start the housing crash with that. Example here is in Cape Coral, Florida. I'm aware of this because I did some stuff down there personally, and we had builders and developers that what they were doing was buy the lot, get the finance, and we'll get the financing, buy the lot, put the home up, home gets built, sell the property, make money, move on, type of thing. Well, that situation is where the city of Cape Coral, whatever the local government down there, got to the point where they stopped issuing permits for building, and they told the builders, when you finish one, we'll give you a new one. Complete a project, here's your new build permit. So flippers got caught with the property. They couldn't move it. It wasn't finished. Maybe if it was there, maybe you rented it, or they milked it until it was foreclosed. Some people who bought into this scheme didn't even have their properties built because they bought this construction to perm plan, and for 18 months or whatever the time frame was, 2 years, because the builder couldn't get you the permit, because of the changes in the local government, you were paying interest out of your interest reserve account in your construction perm loan, and then that reserve account emptied and was zero. So the lender came to you and said, okay, well now you got to start kicking in your own interest, and you went, I don't have the money for that, and that wasn't the plan that was sold to me, and what am I going to do now? So you stopped paying, you didn't pay the interest on that land or that partially finished home, and eventually it fell into the foreclosure process, and most people lost the land, the home, maybe did some short sales occasionally, but most people lost it to foreclosure. And I knew people that did this. They did this in many homes and many projects. And the concept was, well, when the market was turning, I figured I'd make some money or at least break even, so there's no fuss, no mess here, but that wasn't the case. It dropped dramatically and caused a lot of chaos. So again, what was going on here was no concept of loss. So developers were selling these programs where, it was particularly interesting, where you had little money out of your pocket with the, the potential of making a huge killing on this, whether you sell it and flip it, make money, keep it and rent it out, build appreciation cash flow. So there's all these plans to do all this business, and it didn't come to fruition for people. So ultimately what happened, developers got stuck with their inventory, and they suffered. They had to drop prices, which they suffered. They converted unsold units to rentals, which obviously suffered from them and suffered from people who purchased because it devalues property. They lost money. Everyone lost money. They got foreclosed on. They lost the properties. And when I look at this, I think of the Miami era for condos. I think of Cape Coral. There's obviously other mega city issues that happened at that point in time. So a lot of that building frenzy, developing frenzy, caused a lot of problems, and that's a sign of a housing bubble. When developers are not making money, when investor profits shrink or stop, we see that the market is peaked and the market has changed. The rest obviously is history. And then we can look at what happened then as to, I guess you could say, what's happening right now. So I'll talk about that on future videos, what's happening today in the marketplace. But you can see that was a contributing factor to the housing I'll say boom, bust, crash, and crisis. Is an overbuilding, oversupply, a need to get profits and get income, and then timing and issues and not being able to deploy and implement fast enough to get out when the time was right or before it was too late. So that's what typically happened, and the rest is history. Number 9. So one of the other, we're going to do 2 per video here. So another cause of the last housing bubble, or what you see as contributions to the housing bubble, is more people opt in for real estate careers. So this is very typical. So when markets pick up and things look good and there's money to be made and appreciation is happening, more and more people go, hey, I need to get in on that. All right. And whether it's real estate agents, licensed agents, or it's real estate investors, or the industries that serve both, I guess you could say, people want to opt in for real estate careers because they believe that it keeps going, I'm going to make some money on that. So people want to get into the game when there's a surging market. There's no doubt about it. They see values going up, they see appreciation. They hear about stuff in the media and they're like, let's jump in, I should do this now. So it's human nature, whether it's full-time or part-time, it's like I can participate and get something out of this, which is great. They want a piece of the pie, and that's what happened during the last housing crisis. So I wanted to sort of look at this here. So I pulled some statistics, and basically what we had was, just before, the I guess you could say the housing crash and crisis, we saw a surge of real estate agents agent growing as far as becoming a career. So in 2007 they hit a peak of 1.359 million real estate agents, and this information is supplied by NAR, National Association of Realtors. So, and again, the report I'm looking at says, they think right now there's 2 million active real estate agents across the country. The majority are members of NAR, but you don't have to actually be a member of NAR, National Association of Realtors, to be a real estate agent. NAR, you pay a yearly fee to be part of NAR, which allows you to use that realtor term. So I'm a realtor if I'm a member of NAR. If I'm not a member of NAR, I'm referred to as just a plain old real estate agent. So that's kind of your scoop there. So just realize that, again, you have to pay a premium to sort of be in NAR. So interesting thing about this is the fact that I guess you could say the active number of real estate realtors dropped by 23% after the last market crash. So you can see that the numbers surge as the volume and real estate market grows and appreciates, and then when you hit that sort of, we'll call it inflection point, and it goes the other way, the casual person who thinks, hey, I'm good for how many dollars a year, or I want to do so many transactions either for myself or my family and some friends. Those are the casual sort of part-time, not full-time mindset agents. They just don't renew. It's not as competitive now. They actually have to work to get lead sources, etc., especially when the market contracts, It's tougher out there. So guess what? People aren't just buying, just, help your neighbor buy a property, and off we go here. So, again, we see a contraction there as well too. So realize that we're talking about, a 23% decrease. So it's almost a quarter of the realtors disappeared after the last housing crash. So again, you can see there's a run up and off you go. Now, as far as the brokers are concerned, I look at this going, the brokers, it's like, hey, the people who become real estate agents, they take the licensing course. All right, they pay to take the state exam. And typically with a brokerage firm, they recruit. It's not that difficult to recruit, and they don't put out too much money to bring somebody in the door. They do some basic training. Maybe they might buy some business cards or do a couple things for you. But in the end, a real estate brokerage firm figures you're good for a personal transaction, a family member's transaction, maybe one or two friends for the year. So the acquisition cost or time frame to bring a new real estate agent in is very little compared to what they're going to get paid. And typically, if you're a brand new agent starting off, you're not walking into a 80 or 90% commission split where you're taking the majority of that commission and the broker gets a little piece of the pie. Typically, it's a more amicable or broader commission split until you start building up your business and doing more and more transactions. So that's the trade-off. So get trained with the brokerage firm and you're going to pay more out of your commission share, and then as you do more, they're going to move you up into different slots. So again, as far as the brokerage is concerned, why not? We'll take as many people as we can because we know that it's worth our time and effort to have 1 or 2 or 3 transactions per year at a minimum from people and see what happens. So that's kind of with respect to the real estate agents. And funny, so you're going to see it surges and then it drops off and it hits a lower point, and then guess what? It does the same thing again. So, so that's what happened. So last housing bubble, we saw a surge in real estate agents, and then they dropped off right away. So again, everybody wants a piece of pie. Everybody wants to get in the game. And, what does that do to the marketplace? Well, as far as I'm concerned, that just perpetuates the unnatural growth and property appreciation. So, these are people that may not have as much experience in real estate or the best or the more recent skill sets as the agents who have been in the business for a number of years. So are they providing the best guidance to the customers? I don't know. And again, it's really, I want to get in to earn a lot of commission. That's not necessarily in line with helping my buyer get the best deal possible, etc. So just going back to, you can see how, conflicting, desires can contribute to, the overall push of properties. And we see it today where, a lot of people comment on the channel and I get the email saying, my real estate agent told me I need to buy today because it's only going to go up more in the future. Well, that's a very blanket statement that I think is very, inflammatory. And, when people say that, they're not looking at the marketplace and they're listening to maybe what they're being fed. Are they doing real analysis on statistics and knowing what's happening in their marketplace? Not too sure. It's more scare tactics. So that's the scoop with real estate agents. Now, can't forget real estate investors. So obviously, real estate investors are jumping in the marketplace and more people want to get a piece of the pie and get a piece of the action. Why? Because it's exciting and it's interesting, and it's like, well, if I can do a bit of this on the side, I can transition into a full-time job. People want to do that. That's great, and there's nothing wrong with that. But what we typically see when there's a surge of real estate investors into the marketplace, that creates undue competition for acquisition of homes. So when we see competition, what do we see? Prices rise. So a lot of people jumped in the marketplace. Now, first of all, to qualify the number of real estate investors that come into the marketplace is difficult. With the agents, we can qualify that because we can get some basic statistics and we can get some baseline numbers. Well, NAR publishes their numbers, so National Association of Realtors. I can go and I can tell you how many people are have been there the past 10 years, etc. So that's quantitative that we can actually get our hands on. As far as how many real estate investors are out there, I don't know. Do people that have owned more than one property? So is that a real estate investor classification? Okay, then there's 10 million people of those out there. Now, weekend warriors, mom and pa, professional investors who do that as their full income. How do we qualify that, or how do we quantify that? It's very difficult. So my point is we can see the influx and the participation based on pricing. So when you're looking at to purchase a property and there's more than one real estate investor checking out the home. That's competition. When you put your offer in and the seller comes back to you and says, oh, guess what? We have a higher offer from somebody else. Can you better or match or better that? That's competition. So that's not good, and that drives prices up, which means, at some point in time, people are going to buy those properties and get caught by not being able to sell them, or cash flow that doesn't work and values drop, and now your mortgage is costs more than your rent or you're willing to pay. So what do you do? As an investor, the first thing the investors do is they stop paying the mortgage. So they stop paying the mortgage, they stay in the property, milk the rent, whatever they want to do. But it's because it's just a numbers game, there's no emotional attachment to the home, they let it go. So so all this speculation and drive to earn money, when markets change, that's the first thing that goes. Second homes, investment homes, whatever that is, we don't want it anymore, we're not going to pay for it. Yeah, we'll still utilize and maximize the opportunity best we can, but that's the first wave of pre-foreclosures and short sales and ultimately foreclosures is based on that situation. So that's typically what happens with respect to when more people enter into the market. It causes more competition, more chaos, where people want to jump in and earn money, and in the end it just causes more problems when everything sort of crashes. So that's the first two issues with respect to what I guess you say contributed to the last housing crisis back in the day. And we'll do next video, we'll have a couple more. So again, thank you for watching. Please subscribe if you're not already a subscriber. I'd love you to like and comment and share the video. And again, we're more in this segment, we're talking more about real estate investment and opportunities in real estate. So if you're looking for support on that, want to talk about distressed property, short sales, foreclosures, certainly reach out to me. I'll be happy to talk to you about that and show you what I've got as far as training materials and support that we can do and help you grow that part of the business. Thank you.